Good morning. This is the Naples Money Managers with news you can use. And it is October the 4th? Fifth, it is. Wow, look, I'm pulling a dawn. I hope everyone had a great weekend, and we have a couple things to talk about. So as I'm sure all of you know, our president has been diagnosed with COVID-19. It sounds like he is doing well, so that is kind of good news for the market, and the market it looked a little bit shaky on Friday, but has really kind of digested that knowledge and looks optimistic today, especially with his doctors talking about him possibly coming home as early as this afternoon. One of the things I wanted to talk about is this is continuing, right? This 2020, as we'd like to call it. And it's beginning to cause a little bit more weakness in areas that were already a little beat up. Disney has had to lay off about 28,000 workers. 67% of them were part-time, so that's good news. I mean, the majority of them were not full-time workers, but that is a large section of full-time workers. Disney is in negotiations with them to continue their kind of healthcare payments and help them out and help them transition, but that's a big deal. Disney posted its first loss in something like decades, which is what kind of prompted these layoffs. Additionally, the airlines, as we all know, airlines have been really hurt by this. People aren't traveling, people aren't going anywhere. What do you do with all those planes sitting on the ground? Well, unfortunately, the airlines are also laying off something like 40,000 workers as well. So that's hard, but perhaps the biggest area hit would be entertainment. Who's been to see a movie? Have you been to a movie theater lately, Dennis?
No, I haven't, and I'm not considering it.
And I absolutely am not as well, especially when you consider things like Amazon, Netflix, Hulu, the big streaming services have really begun pushing videos directly to streaming, even outside of going to the theater. So with all of that taken into account, Regal Cinemas, a staple of the movie theater companies, is closing all of their U.S. locations, which is very sad. But that does kind of segue with me nicely into Dennis Nelson, who wanted to kind of give us a little bit of a market overview. So I'll turn it over to Dennis.
Well, thank you.
You're very welcome, sir.
Well, I put together a few numbers since we're at the end of the third quarter, kind of seeing where we were year to date. Looking at the Standard & Poor's is trading up about 4%, 3.72 to be exact, and the Dow is down 3%, and that kind of highlights something that's going on. This is a very sector-sensitive market. The Standard & Poor is broken down into 11 sectors, and it really depends on which sectors you're invested in, whether you've made money or whether you're crying right now. So for instance, the tech sector, they call it information technology, but to me it's the tech sector, up 25% for the year. Wow, having a great year.
Great year.
Who would know that if you own some energy stocks, down 50% for the year?
Is that the worst of the sectors?
Those are the extremes. That's right. But you can look at this maybe two ways. Maybe energy is something to be avoided. On the other hand, if you're really looking for some bargains and willing to wait, have some patience, maybe there's some good buys in that category. Suspect there is. But if you've made money this year, you're probably in three sectors: communication, discretion, consumer discretion. That is like Amazon, Home Depot, McDonald's is in that area. That is companies that sell to the public, but if the public doesn't want to buy, well, they won't die. Like a grocery store, for instance.
Well, let me ask you a quick question, Dennis.
Mm-hmm.
So with what you're talking about, and the fact that you kind of started with the markets being up, with the exception of the Dow, the S&P and the NASDAQ are doing well,
right.
The NASDAQ being heavily weighted technology, that kind of paints a distorted picture, right? That certain areas, if you were there, you did much worse.
Well, you look, and that's quite true, and you take a 30,000 foot view of the markets and what's going on. In my view, there's a real transition going on between what I would call the old economy and the new economy. There's definitely a new way of doing business in force and well in force actually over a period of time. So you take like Amazon. Amazon is in the discretion, consumer discretion end of the market, sector of the market, and still doing quite well by all accounts.
Absolutely.
And the final sector that's done well is communications. And the communications may have some stocks in there you really might not think of as communications, like Facebook is the heaviest weighted in that sector, but it's up 10% for the year. Other than that, if you were in banks, you're probably down 13%. Maybe if you're lucky, you're down 13%. Tech or utilities down as well, down 6%. And the rest, the other sectors, kind of even for the year. But it really depends. If you're doing well, you know where the sectors you are in and what you need to be in to continue.
And that could also honestly be a case for, I don't want to say professional management, but professional management, that you could, that a person could look at the S&P being up for the year and be like, oh, well, I could, just buy a SPDR ETF, exchange traded fund, and do okay. Whereas, yeah, you would be up for the year, but you wouldn't have gotten, say, the 25% boost from being heavily weighted in information technology, or you might not have avoided that 50% loss in an energy sector. So there's a little bit to be said about active investment, not necessarily passive.
Yeah, absolutely. You need to work to spot the places in the market you want to be. You just can't buy the market.
Absolutely.
So with that, I will
thank you, sir.
Exit, and we'll get John in here.
And this is John Kincaid. Welcome, John.
Good to be here.
What do you got for us today?
So, thinking about what Dennis and you discussed about this segmentation of the market, and the inability to choose really beforehand which sector is going to do the best, obviously.
Sure.
Hence, we have this byline of diversification that's usually referring to a number of positions in a portfolio versus sector allocation, but both are used. I think it's really crucial to understand that a cross-section of our clients, maybe 50 to 100 years old, are looking for stability. The market can be volatile, so is there a strategy that limits volatility?
Absolutely.
They're looking for income. Right now, if you look at the 10-year Treasury, there's absolutely no income. A lot of liquidity, but absolutely no income. You have to go to the illiquid side of the market, MLPs, etc., to get
any form of income.
Any type of income. Stability is crucial. Income is crucial. And I think time in the strategy is crucial.
What do you mean by that?
So, last week I was kind of looking through some notes and some things that I get from other colleagues, and I got from a colleague a J.P. Morgan Equity Premium Income 40-page analysis of their new mutual fund.
Okay.
And I was intrigued by that because it had a couple of words in it, equity and premium, that I kind of looked deeper into it, and this is what I found. Anyway, this is the 40-page in-depth, but let me just take you through a couple of things and compare it to the Naples Money Managers and our core portfolio, which is a covered call portfolio.
Absolutely.
Right?
This should be interesting.
It's equity with dividends and premium, option premium income. First of all, JP Morgan's been around a long time. They do a great job. They have good managers. They're in all the sectors that need to be, or areas of the market that need to be covered so that a client can get exposure. Interesting thing to me was this fund just blossomed a year ago. So they haven't ran a covered call portfolio in a mutual fund format before that. And I found that was interesting. When I looked at the top portfolio managers, they have about 50 years combined in the market, And between the three of us, I think we have over 80 years, which I found that interesting. Now, I'm not trying to give JP Morgan a hard time. What I do want to compare and contrast here is that what we do is significant.
Yes, yes.
It's significant. Their byline for this portfolio is provides a solution for income-seeking investors, a bedrock of the money management industry, while reducing total stock market risk.
That sounds familiar.
That does sound familiar. So I was interested in that. I thought that was pretty profound in that we've been doing that for over 20 years. Now we do have a 20-year performance history of the portfolio. I talked about lack of liquidity. In other words, in order to get the income, we talked about that, you have to tie up things into securities that do not have liquidity.
Right.
Treasuries have liquidity. The problem is you can't find the income.
I just wanted to stop you real quick
Uh-huh.
there. No, it sounds like from what you said, that previous part, it really does sound like someone could get the same level of income and service that they're looking for from a small boutique firm like us, who could really kind of focus in on the client while still getting the same level of service that they get from a big,
Well, actually more service. You know, I look at
and expertise. Expertise was the word I was looking for.
right. Not only is the expertise here in years in the market and being invested in the market, but also watching the market over time and using this option/equity strategy. They go on to talk about, this is one tagline they had, balances current income with capital appreciation. The covered call portfolio that you know is Mapato does the same. Another one, leveraging a time-tested 30-plus year investment philosophy. That's what this is. Equities with dividends with an overlay. We call it an overlay, but that overlay really drives specific parameters.
Designed to enhance the income.
Designed to do two things, right? Enhance the income and reduce the volatility. So that's what I found out. And of course, I'm a person that would look through these data sheets from Morningstar because I want to see performance compared to different managers. So last year in 2019, their total return was 15.22. Great return.
Very good return.
I must mention that our strategy, same strategy, did 17.78 net of fees. Third quarter, so if you take their option writing strategy of JP Morgan out to the third quarter of 2020, they had a negative return of 2.55, where our return was a positive 4.69. So bottom line through all of this is the strategy that we have been using that doesn't get a lot of press because it's more labor intensive and isn't used out there because of that fact. We now see a major money manager with literally billions of dollars under management saying to themselves, it's time we get something going.
Well, and they say, mimicry is the sincerest form of flattery.
Absolutely.
So we must be doing something right, is all I can say. Well, thank you, John.
Absolutely.
And remember, everyone, money matters, but most importantly, you matters. I am Marcus Bickle. This is John Kincaid and Dennis Nelson, and I hope you all have a great week.